Hi everyone. Um, Welcome to our masterclass series on capital budgeting today. Um Capital budgeting is one of the important decisions which any firm makes. There are various types of decision making which happens within a company. One of them being where to deploy the capital, right? Usually there would be multiple choices which a firm has on where they can deploy the capital. So the firm needs to decide which is the most profitable project, which is the best way, which is the most efficient way to deploy the capital they have to produce maximum returns. So this technique of evaluating capital projects is known as capital budgeting. Capital budgeting may be defined as the firm's decision to invest its funds most efficiently in the long term assets in anticipation of expected cash flows. So, um, the challenge which every firm has is that there is limited amount of capital. So that means they cannot take up every project which they can do. So here they need to decide which project they should do and which project they should let go for now. So what is the most efficient way to deploy its funds? And when we say capital or funds, we are talking about debt and equity, right? So there are two forms of capital a company has, that is, one is equity financing and one is debt financing. So there are pros and cons associated with different sources of funds, and there is a cost of debt, there is a cost of capital. So accordingly, keeping everything in mind, uh, the funds the company has, uh, how they should decide where to deploy those funds in the most efficient manner, that is what we call as capital budgeting. For example, our finance ministry every year comes out with a budget. So they tell us that this is the budget for the country. Uh, this is how we will get the money, and this is how we will deploy the money, right? So on similar lines, a company also does that. That this is our debt financing, this is our equity financing, this is the cost of our financing, and accordingly what should we do with this capital so that we are able to generate more returns than the required rate of returns of our capital providers. That is how we can generate value in the firm. So as you can see in the image here, the company wants to decide whether we should pursue the building of this plant or not. The project cost is $10 million. uh, Now, what will this plant give us as returns for how long? So, uh, all those things come into play while making the capital budgeting decision. What is the objective? Uh, the idea behind doing all this evaluation, doing this analysis is that we want to maximize shareholders' value, right? So, um, if we broadly talk about the structure of any organization, uh, on top we have the owners, uh, shareholders. Um, then shareholders cannot look at day-to-day management of the firm, so they appoint board of directors. Board of directors also cannot do that, so they appoint top leadership management team. Um, Top leadership management team appoints different managers, and below that we have other employees of the organization. So all of them are working towards creating more value for the firm, creating more value for the shareholders. Maximizing the shareholders' value is the objective with which all of those resources in the organization are working towards. Uh, so, this is one of the most important decisions in terms of trying to maximize the shareholders' value. Features of capital budgeting decisions. exchange of current funds for future benefits. So what we are doing, we are deploying the funds we have currently for future benefits. So the funds are going out today, but the future benefits will accrue over next 3 years, 5 years, 10 years. So that is where time value of money comes in also, which we will be taking into account while looking at various capital budgeting techniques. Funds are invested in long term assets. So here we are not talking about short term decision making or working capital kind of decisions, right? So here we are not talking about which inventory supplier to choose, or from which company can we source the laptops. Those are more of smaller term, or more of relatively smaller decisions. But here we are talking about long term assets, fixed assets, or those investments which will generate returns over multiple years of time. So this is more of, that's why we call them capital projects or capital budgeting, because here we are talking about projects or investing in assets which will generate returns over more than 1 year, maybe 5 years, 10 years. Future benefits or cash flows will occur to the firm over a series of years. TVM comes into play. So as we discussed, we are making the investment today, but the benefits of those investments will come in next multiple years. So the money which is coming in later needs to be discounted back and evaluated in terms of the present value of benefits. So that is where time value of money comes into play. What is the importance of investment decisions? As we said, there are multiple reasons why these decisions are very important. First is they influence the firm's growth in the long run. So when we say long run, over multiple future years, how the firm will look like, what are the cash flows, what are the profits the company will be able to generate, will depend a lot upon what capital budgeting decisions the firm has made in previous years. So those decisions, whether they are turning out to be correct or not, that will determine how much growth the firm is able to see in the long term. They affect the risk of the firm. That means if the management has decided to enter into a risky venture, that can significantly impact the earnings, make the earnings more volatile, more unpredictable, and that can result in huge losses also if the project doesn't turn out to be the way the management thought out to be. So again, what is the risk involved in the project? That also can significantly affect the risk of the overall firm. Third, it involves a commitment of large amount of funds. So as we said, these are like investments into long-term assets, fixed assets. So a large amount of funds, a large amount of capital will be deployed in these fixed assets, and then they will give us benefits over multiple years. So we need to be very careful where we are deploying these, because this is a large amount of funds. Irreversible or reversible at a substantial loss. So it's not easy to take a U-turn after we have decided to go ahead. For example, a company has set up a factory. Then it's not easy to, after 1 year, decide that this is not working out, let's shut it down. So that could result in a substantial loss, right? So um, large amount of funds were invested. Now you may not find any buyer for that factory, uh, or if somebody decides to buy also, it could be at a significant discount to the cost we incurred in setting up the factory. So um, these are not easy to reverse, and even if reversed, it will result in a substantial loss, and most difficult decisions to make. So that means, because a lot is at stake, large amount of funds are invested, these are impacting the riskiness of the firm, these are not reversible, uh, and they are influencing the growth in the long run. So uh, there is a lot at stake when we are making these decisions, and the capital is limited also. So once we have decided to deploy the capital for a particular project, it's it it can have a significant impact in terms of where the company stands after a few years. So one of the most difficult decisions, need to be very well thought out decisions for the firm to make. Yeah. So let's look at these in more details. Firm's growth in the long term. First importance of investment decisions is it impacts the firm's growth in the long term. A firm's decision to invest in long term assets has a significant impact on the rate and direction of its growth. Unwanted or unprofitable expansion of assets will result in huge operating costs to the firm. A wrong decision can make it hard for survival of the firm. On the other side, inadequate investment in assets would make it difficult to compete with peers. So these decisions impact the growth of the firm in the long term, right? For example, um, Aditya Birla Group has recently decided to enter into the paints industry. Um, they have launched it through Birla Opus. That is a capital bursting decision. That is a decision where they have decided to invest a large amount of money for building up their paints business. They were not into the paints business earlier. Uh, they were into other businesses, but not into the paints business. So uh, this is one of their capital bursting decisions where they have decided to compete with the likes of Berger Paints, Asian Paints, Kansai Lanrak, ExxonMobil. These companies are their major competitors, and mm, they have decided to go ahead and uh, make an entry into the paints industry. So now it will depend how they are able to execute, how much market share they are able to capture, and it can impact their growth in the long run. Similarly, uh, automobile company, they decide to invest in electric vehicles, or they decide to invest in uh, hybrid fuels, or uh, biofuels. So what what is the basis of our decision making, right? Where do we see the technology going? So it's not easy to suddenly move from petrol and diesel to electric vehicles, but at the same time, if we do not move, then we may fall behind also. So uh, that is the riskiness involved in such kind of projects, but they are also important if we want to survive in the long term, keep up with the technology and keep up with the advancements. So these are important decisions, and they impact the growth in the long run. They affect the risk of the firm. Long term commitment of funds may also change the risk attribute of the firm. For example, if the investment increases average gain but causes frequent fluctuations in its earnings, the firm will become riskier, and thus the investment decisions shape the basic risk attribute for the firm. Even announcement of a wrong capital budgeting decision can impact the share price significantly. So that means we should look at the strengths of our firms, where we are good at, and accordingly try to expand or diversify. Uh, we should not take up such projects which are looking very attractive from the profitability perspective, but involve a lot of risk, or involve that kind of decision making which the company does not have the skill set of. For example, let's say FMCG company suddenly decides to enter into the um, heavy trucks, heavy machinery building, right? So that would be considered very risky from FMCG company's perspective. FMCG is a much more stable, different business than um, getting into heavy commercial vehicles. So that that may look attractive, that there is a lot of profit, there are not enough competitors, etc. But uh, the company should take the decisions, do the decision making, which should not affect the riskiness of the firm too much, uh, because again, large amount of capital is involved, and these are not easily reversible, and hence they can significantly impact the overall riskiness of the firm. So market knows all this. When the company announces any big project which they plan to undertake in future years, the market does its analysis, and accordingly it can have an impact on the share price also. So if any publicly listed company announces that they are venturing into a very risky project which can give huge returns or may result in significant loss, uh, the market will do its own analysis, the market participants, and accordingly they would decide whether to buy or sell the stock, and that can have a significant impact on the share price movement of the publicly listed company as well. They involve commitment of a large amount of fund commitment of the for the firm to for its investment programs is very huge, and it should be planned very carefully, and make an advance arrangement for procuring finances internally or externally. Capital should structure should not get distorted. External funds can be arranged by either borrowings from financial institutes. So what we are trying to say here is that there is a large amount of funds which need to be deployed for making such investments or for undertaking such projects, and we need to decide from where we would get the funds. Either it could be through debt funding or through equity funding. Now, debt funding, although relatively cheaper than equity funding, but the problem with debt is that it's a fixed commitment. So we definitely need to pay the interest on time, make principal repayments on time, if we want to service the debt. And that may not be easy if there is an economic downturn, and company is not able to generate enough revenues and profits, then it might not be so easy to service the debt. So although cheaper, but if it is large amount of debt, it can increase the riskiness of the firm. It can bring into question the sustainability of the firm uh, in the long run. Other source of fund could be equity. Uh, with equity, if we keep on diluting, if we keep on issuing new shares to raise more equity financing, that would also give a negative signal to our existing shareholders. So too much equity or too much of debt borrowing can backfire in the long run. The firm should rely more on internal source of funds, that is the profits, the cash flows they are generating from operations on a day-to-day business, on uh, their core operations, right? So that internal source of funding is usually the most sustainable and the best way to uh, um, rely on funding. So again, it's very important that we take these decisions carefully, because huge amount of funds is involved, and we should not be relying too much on external debt or too much of external equity financing. Irreversibility. When a firm makes a large investment over a project, they are mostly irreversible in nature. It is difficult to find a market for such capital items to pass on once they have been acquired. Sometimes, even if they find someone to buy it, they would acquire it at a discount or scrapped rate. Right? So, as we discussed, let's say a manufacturing company has set up a factory at a remote place, and after 1 or 2 years they find out that it was a wrong decision. Now it is not easy to reverse. They cannot just uh, get back the cost they have incurred um, in setting up the factory. Not only the factory, you would be incurring costs related to land. The company would be incurring a cost related to staff, employees, managers working in that factory. So suddenly deciding to shut down the factory, um, s- um removing all the employees, um, selling off the land and machinery, this is not as easy. And even if you find a buyer, that buyer will definitely exploit the situation and make use of the situation, and um, would be able to purchase it only at a very discounted or a scrapped rate. So this can result in a huge loss for the company if they want to reverse the capital budgeting decision which they have made earlier. Mostly complex decision to make investment decisions are the assessment of future events for the firm, which are difficult to predict. So much uncertainty involved. The estimation of future cash flows depends upon economic, social, political, and technological forces, which causes an uncertainty in estimation. So uh, there is so much in uncertainty involved. Uh, for example, right now we are seeing that uh, AI is making waves, and a lot of technology companies are investing a huge amount of money in building their AI capabilities, um, deploying the use of AI in their day-to-day operations. So now let's imagine a tech company invest a huge amount in AI for 5 years, and then some new technology comes up which can cause a huge disruption suddenly. So it's very complicated. It's not easy to predict the future, especially in the technology space. And similarly, these decisions can be impacted by other factors as well, like uh, political factors. For example, there is a lot of push of ethanol blending in petrol in India. So um, now this is more of a push we are getting from the government, that let's use more and more ethanol and blend it into petrol for our as a fuel. So now uh, a sugar company, let's say, decides to invest a huge amount of money in building ethanol capacity. They set up a plant to specifically for that purpose, and tomorrow the government changes or the policy of the government changes, then it can bring in a lot of uncertainty in terms of what the future will look like. So uh, not easy decisions. Similarly, let's say we have made the decision um, in 2019 or start of January 2020, and suddenly we see that COVID struck. So um, there is there's a lot of uncertainty in terms of economic, social, political, and technological forces, which can cause a uncertainty in the estimation. So that's why these are not easy decisions to make. These are very complex decisions to make.